Hello everyone, welcome back to another Go charting video. In today's video, we're going to discuss something known as the internal clock of the market. So although it is a concept related to market profile, you can apply it across various other charts, for example, volume profile and even the cluster or the footprint charts. So we'll go one by one, we'll understand what it is. So even for people who are new to market profile or who do not understand it, this is a concept that is quite easy to understand. So all you need to have is these charts and not know anything else. For example, the excess or the single prints that people keep talking about in market profile. So this concept was, initiated or brought out by Steidelmeier in the market profile book of his. But the thing is that some of it, or in fact the whole of it, was in a way brought out by James Dalton as well. If people are not familiar with it, market profile is a tool that has been in the market for years. James Dalton is considered to be one of the godfathers. Then, of course, Peter Stadelmeier came out and elaborated on the various aspects of it and so on. So we'll not get into where and how it has come into place, but it is really, really effective in even today's markets. So what both of them actually say is that the market moves from balance to imbalance. You've heard me say this a lot of times. So what it means is, in layman terms, is the market moves from a consolidation to a trend mode, again to a consolidation to a trend mode. So it is balance to imbalance, you can call it. Okay, now what Stadelmeier said is that I will just go, he says that the market moves from one step to the other, and generally there are four steps to a market at any stage. So he says that the first step is a series of prices in one direction, that is the trend mode. So let's say this is a trend mode, if you can call it. So the market is moving in one direction, that is step one. Then it trades to a price to stop the market. For example, it goes up and there is a price which stops the movement that is going on. So this is a one directional move, it is gone, and there is a place where it stops, the price stops and it stops moving in that direction. So in other words, you can call it consolidation. And then the price, this third step, where it develops around that price. So it starts balancing again, the imbalance and the balance phase. So it can be called the step three, that the market is, step one is the market has moved in one direction, then there is some price, or you can call it the other side, or the sellers have stepped in, and some people call it the other time frame, and so on. So it is moved to a price where the price is stopped, that is the step two. And the step three is the price has started developing around this area. So this is called the balance phase. It is happening in all time frames. So this is a 30-minute time frame. Of course, this is more powerful because the larger or the higher the time frame, you get better moves and higher probability moves. Okay, and the last step is after the price is consolidated, or the price has developed around this particular area, or the stopping price area. The price, if it has developed for a time longer than usual, so for example, let's consider this case, it has been going around and balancing in this area for a long time, it generally tends to move away from this area, move away from the direction of the first trend. So if it has happened for a really long time, it will generally move away back to the area where it started from. So this is the area where we can which we can consider the price has been developing around for a long time. Okay, so these are the four steps. So we'll just summarize it. Step one is when the market tends to move in one direction. Step two is there is a stopping price. Let's say this is the area where the price stops. Step three is the market develops around that area. And step four, if it has happened for a duration longer than usual, the market would tend to move in the opposite direction. What Stadelmeier says is at least to one standard deviation from this place. So it can be, if this is the balance area, at least one standard deviation is what it should generally go to. Okay, now again, it is a little tricky in the sense, very easy and easier said than done, to firstly know what is the what is longer duration, or what is the time when it takes to develop around a price, how much has it taken, and what is long. For example, if it is 2 days, 3 days, and the market continues in that direction, it is not long. If it is, for example, like this, 6-7 days, it is long. So what Peter Stadelmeier further says is that every particular stock or index has its own internal clock. So this, whatever we just explained, is called the internal clock. He goes on to say that with the help of this internal clock of the market, we can objectively know at which stage the market is in. So the 3-4 steps that we just spoke about, he says with the internal clock of the market, we can objectively estimate or have an estimate of where the market is. So for example, if the market was moving like this with I mean not as thick as profiles, with thin profiles over here, and a thick profile here, we can see a prominent POC here, over here. Again, we'll discuss it sometime later. So as of now, just remember, wherever we see thin profiles, it is with the help of these profiles we can estimate or have an estimate of where the market is. For example, after at this price and the market doesn't move above this and stays in for 5-6 days, we can I mean have an estimate that the market is certainly in step 3, or because this price has stopped the market moving towards the upside. The first thing we notice is at this price where this up move happened, the trend day happened, and the thin profile, the market doesn't even take out the single prints in the later half of the session. That is the spike. You can again leave it. Just know that in the later part of the session, the thin profile, you can see this areas marked in magenta. These are the single prints. The market is not able to even take out the first single print. So as of now, we've not seen the stopping price as such. This is the first time when the market comes in and isn't able to take out the previous high. So this is the first time we can see a stopping of action taking place. The other thing we notice is a lot of thick profiles happening over here. So that is what it makes us believe that we are in step 2 or step 3. Okay, so because we started developing around this stopping price and we're not breaking this. Step 4 is when we step 4 is when we do consolidate a lot in this zone and finally move down to this area where we broke out from. Okay, so with the help of these thick and thin profiles, we can have an estimate of where the market is, and this is what he calls the internal clock of the market. So what he says is every stock or every index has its internal clock. So what you can do is we will just go ahead and just decipher this action in terms of internal clock. So you can either count the number of these blocks in each row towards calculating your internal clock. Let's say this is for Bank Nifty. I've got the spot here, not the futures. It is because that the futures, we've just entered a new contract. We've just entered the first day of the contract. That is why I've not done it. So we have a continuous sort of a thing at present day. That is why I've chosen the spot chart. You can go ahead and choose the futures chart also if you want. Okay, now let's start with decoding the market one by one with respect to the recent activity that has taken place. So you've seen me in my previous videos also. The videos that I do about market profile is I tend to mark these balance areas and imbalance areas. This is exactly the same thing what about the internal clock. So I generally would have seen me mark these balance areas like this. So what we're going to do today is not have these balance areas being plotted manually by me, but I'll just show you how you can do it quite simply without any deeper understanding of market profile. So you can see this area where I've seen a lot of thick profiles develop, and we'll just go ahead and start doing something like this. Okay, merge profile to the left, again merge profile to the left, merge profile to the left, and you immediately see the area where the price has been developing a lot. So as Peter Steidlmayer says, so this is the area where you have the maximum number of activity or the amount of activity taking place, and the market isn't even able to breach. If you see this thick area, it has not been able to breach in the last 4-5 days into this area, even test this. This is an indication that the market is quite strong. So even though we were having a sort of a consolidation and market trying to go down, but a bearish move at that point was not, in the cards till the time we at least took out this area. So when we look at this area and this balance area in the market, trading above this, it is a subtle clue that the market might move up. The other thing, sometimes it can happen, what can happen is the market can go up for a day or two and then break down and then go down really fast. Now this again is a case I will just discuss, but again, as we see, it has been happening for a lot of days, okay, and after which the market breaks out. So let's go ahead and do the same thing over here. So if we go merge to the left, so these are the 4 days that we had just before this breakout that we experienced. So you see where the market is broken out of, and this is the area that we tend to or should be holding if the market is to go up. So this is the value area high. If you look at this thick area is almost similar. So this is the value area high, and so this open, that is 46,900, becomes an important reference. So as I said, sometimes what the market will do is go above this area and come back. It is called as look above and fail, and look below and fail. We've heard me talking in the market profile videos previously. So why it is so important is because it has gone up, trapped some of the traders who went long maybe over here, and come back in this area. So the target then, what we expect is 46,800 and 46,400, and these are really high probability targets. The market generally tends to go to the other end, and this is what we can expect. Okay, now what we'll do is we'll go one step further. We'll merge these two profiles as well, so that we get something like this. Okay, so over here what I'll draw is a value area sort of a thing. So till the time we don't come inside this area, okay, this is the area 46,800, we are well above this place, and hopefully we should not, if we are to go long or we are to go higher, this is the place we should not breach. If we do, we target 46,400. So this is a way of doing it in a longer time frame. Of course, the probability increases really a lot when you are looking at higher time frames. That is, this is the 30-minute time frame, and of course we have done almost a 2-week profile so as to arrive at what we have arrived. Okay, now we are in this phase, and what we're expecting is at the least this area to be tested. Now we'll do a similar thing, and before the market came down, what did we see? This 6-7 days of profile. So we'll do a similar thing over here, merge to the left. We again go and merge to the left. So you see, it is as simple as this if you do not understand market profile to the T as of now. Okay, and you'll see something really interesting when we keep merging to the left. And this is the last one we'll do. So you see where the market is broken down from, okay, and where the market has currently taken support of. Okay, so this is the area where we broke, and this is exactly the area where we saw a sharp fall in the end, or we can say like Peter Salome said, there is sort of a stopping price. Now again, the action of Monday and Tuesday becomes important, where we start trading. So what we can do is, like we saw over here, we can balance for 2-3 days if we have to move up and then take a move up. If we do that for a longer duration, that is 4-5 days, and we do not reach this area that we have just marked, we might as well come back here for a test of 46,800, and if we breach, we go down to 46,400. So and the market can keep balancing around these two zones for a long duration, because you look at this profile, this is really thick, and that is why we saw something what we saw yesterday, that is. Okay, now similarly you can go ahead and keep checking and keep looking for people who those who are not, who are new to market profile. So like this, so you see again a range after which the market broke out here. You can do the similar thing, merge to the left, and you will find really good and interesting stuff for longer time frames. Even if you're investing, it is really good stuff that you can find. Okay, so you can just merge these balance areas and you will find something really interesting. So you see why the market it took out from here and is taken support here, and it is done a lot of times because of this particular zone from where we saw the price stop, develop, and then move in one direction. So now when we look at these charts, okay, so of course this is not a balance area, this is a volatile move that has been happening. So if we look at the balance area, what we see here is something of this move. Okay, I'm sorry for that, this move, then it comes back here, and this is the area that is holding. So unless until we're breaking this zone 45,800, we are not going anywhere. Okay, down, and similarly, unless until we break this 47,300 or 400, the recent spot where the market took support from, we're not targeting anywhere above 48,000. So if we are here, we continue this zone, and you can play out these zones and create your spreads, and in a similar mesh fashion keep trading along these lines. Okay, so you can do this in all types of balance areas. Again, this is some balance area. So once you keep looking at these charts, you will get a hang of where to look for and how to look for it, and you will find these areas really interesting whenever this is again a down day. So this is an area where we saw the market break out of, and as soon as we approach this area and we broke down of it, this is the area we targeted. We just went to that area. This is similar to what we are looking over here. So if we again move to this area, is exactly the similar situation I'm talking about. We are going to test 46,400 at least. Okay, so in this fashion you can draw all the areas, and this is exactly what is called the internal clock of, let's say, bank nifty. Okay, so this is on a longer time frame. Now someone will come and ask, what about if we wanted to let's unmerge these profiles, so get to understand the next concept that I'm going to talk about. Okay, and we will see some things. So let us delete all this again, and we will see the profiles after unmerging them. What I want to show you is how we can do it at a smaller time frame level. So that is, we're talking about a daily time frame, or even 10-15 minutes. We'll go to that in a moment. So this is what has been happening lately. So how can you put an estimate to what has been happening on a daily time frame? So you would have seen me marking these POCs with a different color. So this is prominent POC. This is exactly what it means, that when a price has gone down, for example, the price has gone up over here, it has broken a zone of the balance area that we spoke about. So this is a zone which it broke out, and then when it goes here, you see a stopping price. That is, you see a POC on an intraday level like this. Okay, so it is called a prominent POC because I've set it. You can go over here and set it to 10. If you go here, and this is how the prominent POC comes into play. Okay, I will just go down and show you where I have done this. So you see this PPOC, and I marked it with a different color. So the market has gone up here and has stopped here, and this is quite normal. So the first day is normal. It is after the third or fourth day that you need to be looking into the charts and these charts more intensively. So what do I mean by that? This has gone up. This is quite normal. After an uptrend day, it is trying to break out of the balance, out of the now after that, what it has done is it has moved down, and this zone where it broke out from, it started holding on and creating other prominent POCs. So you can see this happening. When you see this, when this is happened on a gap down, a lot of guys would consider this it's gone down, it can go down. But when on a down day, you see something like this, exactly quite similar to the POC of the day when the breakout was on. So it is an indication that the market is trying to hold this place, and the next day is the real clue. The market isn't able to take down this POC and forms another POC over here. So the most probable outcome of this move is it is gone above. Now if you look at what we were talking about, the zones, how long or what is the internal clock of the market. So you see, it is, if the market is to break out of a zone, it is generally, for bank nifty, you can notice it within 3-4 days, it generally moves out like this. Okay, if it would have taken a longer duration, like we spoke about here and days behind that, we would generally have a move back in the direction where it started from. So for example, it was 7-8 days, we could have moved, and it was here, we could have expected a move down again and a test of this area at least. Okay, now having said all this, what if the market, this is the first case scenario that we discussed, if the market comes back in this zone and breaches this zone that we spoke about? Okay, so what we're going to expect then is a test of this area and a low, and the lower area that we spoke about in the first instant. Okay, now let's go and see this, if we can see something like this on a different chart, let's say a cluster chart. Okay, so we will see if we have one of the clusters charts. Okay, so Nifty, and what we're going to do is we're going to select a 15-minute time frame, because at least that is what will make sense, and we'll see if we can see something like this. Okay, so you heard me talk about continuous POCs. This is exactly the same thing over here. So this is the time-based chart, that is a 15-minute chart, and based on volumes, if I go here and I go to the last part of the day. Okay, so this is the breakout that we had, and let's see something where we saw something similar. So what do we need to see is we need to see some areas like this. Okay, I'm just giving you an example, and when the market breaks out of that zone is somewhere we can expect a move to the other direction. It is again relevant for a time frame that we're talking about. So for example, let's get this thing out, and you can see this area, and let's color it black. So you can see this continuous POC areas. Again, when the market takes three periods, okay, three time periods, and the POCs are quite close to each other, and the volume has been accumulated, and there is some amount of time spent. So when it breaks out, it is your entry point. Okay, and again, this happens at the later part of the day. That is why it is not so relevant. It happens at 2:30 and 3. But when you see this thing happening earlier in the day or somewhere before 1200, 1300, you can get really good moves out of that. So let's see if we can find something over here. Okay, so this is the latest day that we have in picture. Again, it is not here, but you get what I'm trying to tell you. There are occasions when you get these continuous POCs quite close to each other, and that is where you need to make sense of it. So for example, let's consider this, although it is not a good continuous POC bars or two bars. So these are just two bars. So if you have 3-4 like this in close proximity to each other, with the bar, with the auction or the market or Nifty future spending a lot of time, and the POC is quite close to each other, and whenever the market breaks out in the other direction from that place, we can expect a good move and we can take our entry point. Similarly, if we have this consolidation happening for a really long time on a 15-minute time frame or even a 5-minute time frame, and you see something like this, the market spending a lot of time in that particular area with the volume clusters very close to each other, you can have this you can play this out, and it works out really well. So before we close, let's see if we can find this is one area, if you can see. Okay, and the market has broken out of this zone. So this is a 15-minute zone, and you can see this zone. So a lot of volume cluster happening in this place, and the market breaks out. Again, this is quite similar to the market profile we saw, and this is for a 15-minute time frame. What Peter Stadelmaier used to do is have this constructed even for shorter time frames, and see on a candlestick chart something like this. Of course, you didn't have the footprint then, but you can use it with tools like this to your advantage and find the zones and the consolidation areas that you have, and how long have they been holding. If they are to go up, it should not be, let's say, more than 2-3 15-minute bars, and it should go up. If it is holding for a longer duration, there is a very high chance that we're going to break on the other side. So this is one more zone that you've seen. Again, this is the daily profile. If you see on the market profile, this is a very big consolidation zone, and the POCs were all so close. Okay, so when you see something like this consolidation, the breakout, and the next day is surely a buy. If in case we come down again, you have to take your loss, and you can expect something on the other side then. Okay, but generally, if it's broken out like this, you can take an entry and expect a huge move on the other side, on the upside, on the next following day, if we break out of that zone. So hopefully this video was of some help to you guys. Until next time, thank you. Bye bye.